morning, everybody, and welcome to the Fred Report Technical Market Conference Call for January 20th, 2011. We'll get right into it. First of all, I do want to wish everybody a very happy expiration. We're seeing all sorts of expiration shenanigans with the Dow practically not going down at all yesterday, IBM going to a whole new strike price, and of course the real fun was the rest of the market sort of selling off. But this is typical expiration stuff, and I guess we have to say we still have our caution flags out. Yesterday's decline actually did move our price oscillator, the Fed's price oscillator daily, down near a buy zone. It was sharp enough to do that. The weekly is still overextended. Frankly, we'll see what this market does. It through 130 or go through 126 on the SPY. Whichever it does, it's going to go with for a little while, so I think we can see some patience. As I said in the midweek, guys, we get in these positions occasionally. They usually don't last too long, and the nice thing is that when we're through with this, we'll have a move that lasts, in direction for a couple of months. We note that the things that are wrong, like the transports, like breadth, all this can be fixed with a couple of good days and a couple of good breadth surges. It's still amazing to me, looking at things, that the McClellan oscillator 100 in the last, several weeks, basically. But we'll get a surge and we'll go. What I would say in the meantime is I would slug my stops up on issues. We're seeing some, greater than average weakness in some stocks that have been strong. If you do get stopped, I'd simply wait to deploy the cash until we see which direction we're going to go. Speaking of deploying cash, we'll talk about this in the stock section, but in the last sector report, we did redeploy our cash and make tech an even weight. The reason I stayed underweight that was I was concerned that the market would simply fall off at the beginning of January, and obviously that has not occurred. I know most people's models have to be 100% invested. It's hard to be in cash with the models that are at the firm. So, and we like tech. We think that tech is going to do better than average. If we do get a decline here, we may end up moving back to an overweight in technology. So for now, stocks still caution flag out. Enjoy your expiration week. Tomorrow's probably going to be a nothing day the way we've gone so far this week. And we'll be back in the saddle again with some more exciting stuff next week. In terms of the bond market, we're still seeing buy signals on our bonds. They're not trading extremely well. They haven't made new lows yet for the move. But I just note that we're still showing buy, but they are acting weaker than expected on the Treasury bonds. I would still, if you are a bond buyer for clients, take a look at the LTD, and some of the corporates here look a little bit better than Treasuries. I'm avoiding the HYG for now simply because that is a proxy for risk. If we do get a market correction, HYG could head to 89, 60, 89, and that would be a great buy point for that ETF for a move up to 92, 93. We're seeing gold down this morning. The commodities have a tendency to weaken at the end of January. That actually may be coming a little bit early this year. They were stronger than we've seen for much of December, in a while. So, and these seasonal dates aren't hard and fast. The important thing to me, though, is gold, the GLD, looks like a giant trading range from, say, 126 to 128 on the bottom to 138 to 140 on the upside. Frankly, I think we'll hold 130. I would be very comfortable looking to buy the GLD if it were to get to 130. And we'll just see if it does that. If it does that, we'll probably even put that out as a trade. We are maintaining our 17-month target of 152, which is 15.20 an ounce on gold. Looking at the DVC and some of the other commodity indexes, those are still trading pretty well. We're expecting a really strong year for commodities in the second half, which will probably be helped a lot by the agricultural commodities like JJG and MU. If you have clients that want to position in some of these commodity names, I would say it looks like you want to be buying MU somewhere between 54 and 51 for a trade up into the 60s by the end of the year. I would do that sort of gradually. The idea is we want to have positions in that by May and not necessarily right away. So, we'll take a sort of a gander at those commodities as we go along, with the idea being that we want to be invested by May.